Welcome to FinBot Insights. Today, we're diving deep into a two-fund combination that's gaining a lot of traction in the investor community, with some claiming it's the ultimate strategy for generating income. We're here to put that claim to the test. It really all started with this, a pretty bold claim from an investor on Reddit. This is the catalyst for our entire analysis today. Does this two ETF combo really live up to all the hype as the ultimate pairing for income investors? All right, let's get right into it. First, we're going to break down the hype surrounding this strategy and define the precise question we're setting out to answer with a rigorous, data-driven approach. And this is the core question that will guide us. Throughout this explainer, we'll be using hard data and a balanced view of the evidence to determine if this strategy truly performs as advertised. Now, before we can properly judge the combination, we really need to understand its individual parts. So next, let's break down exactly what each of these ETFs is designed to do. The first component is GPIX. This is a covered call ETF that's built to track the S&P 500 index. Now, at the same time, it sells call options against its holdings. The whole point of this is to generate a high monthly income stream from the options premiums. But there is an explicit trade-off. You're capping some of the upside potential, especially during strong market rallies. The second component is SCHD. And in stark contrast to GPYX, this ETF is all about long-term stability and growing income. Its strategy is to invest in financially sound, high-quality U.S. companies that have a proven history of consistently increasing their dividends. You might know them as dividend aristocrats. And this slide, well, this really gets to the heart of the strategy. You can see how these two funds are designed to be complementary. GPIX provides high income right now from options premiums, while SCHD is built for growing income over time from company dividends. The idea is to get the best of both worlds, high yield today with the potential for income growth tomorrow. So now that we know how the pieces work, let's look at the strategy as a whole. And we're going to take a very balanced look here, examining both the pros and the cons. The case for this combination really rests on four key pillars. First, you get a high combined yield for that immediate income. Second, you are diversified, blending broad market exposure with SCHD's defensive high-quality stocks. This can make the portfolio more resilient in choppy markets, all while SCHD's growing dividend adds that all-important potential for long-term growth. To put a real number on it, just consider this. A hypothetical portfolio of about $249,000, split 50-50 between these two funds, could generate around $782 in monthly income. You can see why, for someone in or near retirement, that kind of consistent cash flow is the main attraction. But of course, no strategy is perfect, and this one has very clear trade-offs. The biggest risk is opportunity cost. Because GPIX sells covered calls, you will absolutely miss out on some gains when the market is rallying hard. You're trading that huge upside for more consistent income. It's also critical to note that this high income can be far less tax efficient if you hold it outside of a retirement account. You know, to be called the greatest, a strategy has to beat the competition. So how does this combination actually stack up against other popular income pairings? Let's take a look at the data. This table really helps put things into perspective. Now, if you look at our GPIX and SCHD combo in the first row, you can see it has a solid 6 to 7% yield with a relatively low expense ratio. But it's not the winner in every single category. If you wanted a slightly higher yield, for example, you might look at the JPQ combo. And if your priority was total return over current income, the SCHD and SCHG pairing performed better, though at the cost of a much lower yield. This just highlights that every combination involves a different set of trade-offs. So after examining the mechanics of each ETF, weighing the evidence for and against the strategy, and comparing it to its peers, we can now deliver our final verdict on the central question of this explainer. So the crucial point is this. There is no single greatest income combination that is objectively superior for all investors. The optimal strategy is entirely subjective. It must be aligned with an individual's specific financial goals, their personal tolerance for risk, and their investment time horizon. So who is the GPIX and SCHD combination actually for? It is a fantastic option, but for a very specific type of investor. Someone who prioritizes high, steady income over maximizing growth. Think retirees or those who are close to retirement. It is for people who want a more defensive portfolio and who are willing to accept the trade-off of capped gains in exchange for that reliable cash flow.
Ultimately, the most important takeaway is not to find a single best strategy, but to select the one that best aligns with your own personal financial objectives. The right question to ask is, what are you trying to achieve with your portfolio? We hope this analysis has provided some clarity. For more data-driven explainers, we encourage you to click like and subscribe to Finbot Insights.